You saying that the slowdown is undeniable. And I'm wondering how two people can look at the exact same thing and have come diametrically opposite views on reality. I mean, the economy is either slowing or it's not. It's the binary issue. One argues it's great. The other says it's slowing.
Who says it's great?
Jim.
Jim doesn't say it's great. He says that it's not in a recession. I mean, Jim, you should speak for yourself. I don't think he's saying it's great.
He didn't use the word great, but he painted a picture. He painted a picture of an economy that's really strong. Okay, that the consumer's strong, manufacturing is strong because of onshoring and all these other issues. I mean, his point is clear.
I think his point is that there are attractive equities, that the market has suffered. We went down 20%. We have been in a bear market. And if you look at sectors like communications down, 40%, discretionary, consumer discretionary, technology, a lot of the market really got destroyed last year. So I think Jim has found opportunities, and he's looking to capitalize on attractively valued equities.
All right. So let's go back to Jim. Let's go back to Jim, because I don't understand how we're confused, which we appear to be here. Mm-hmm. Your point on the economy is what?
It's simple.
Give it to me.
We are strong right now. Your point, you and I have done this enough times that I can do this, okay? Your point is, yeah, but that's right now. What's to come?
No, Kerry made the point that it's undeniable that the economy is slowing.
Okay, I don't see that. And I can give some credence to what she's saying by looking at, for instance, yesterday's Empire Manufacturing Survey, okay?
I mean, a lot of the data is weak. Let's just.
A lot of the data is strong,
unless you're at the dinner table every night with Scott Kirby,
he just nailed it.
CEO.
He just nailed it. Okay, manufacturing is weak. I think it's temporary. I think it has a lot to do with housing, frankly. Okay, and we've got to acknowledge that housing went down because mortgage rates doubled. Well, mortgage rates have started to back off. And, by the way, there's still demand for housing. All right, that's not going away. People adjust. Prices adjust. You were talking about KB Home, I think, last week. And housing will come back. But my point is about the economy overall, not just manufacturing, which I think we've acknowledged over the years is smaller than the services component of the economy. So when I do, and you're correct, I do talk about Mr. Kirby, Mr. Bastian, the airlines, what's going on in Las Vegas, it's actually kind of important. But my point, the overarching point I would make is, on the whole, the data is quite strong, particularly and probably because of the labor market. Now, leave aside, I know everybody wants to shout at me, yeah, but that's going to incite the Fed. It's going to incite the Fed. Leave it aside. The question you asked me is, what is my opinion on the economy? Right now, it is strong. Let me phrase this just ever so slightly different. We have not seen the recession yet. Some people come on and they say, we're in a recession, or the recovery will look like this. You have not seen that. Fourth quarter GDP, sorry to do this again, 4.1% as predicted by the Atlanta Fed. Real GDP, 4.1%. We're just not there yet. It may happen, okay? 425 basis points of rate hikes is serious medicine. It may happen, but we're just not there yet.
Well, those rate hikes, Rob, are going to have an impact, right? Morgan Stanley's Mike Wilson on the network earlier, he still thinks earnings are going to disappoint and that stocks are still vulnerable. And he doesn't see a trough in earnings until the fourth quarter of this year or the first quarter of next. It's all about, it's all still ahead of us, regardless of how things look now, right? The market's going to anticipate what's coming, and there's still pain ahead in lots of people's minds.
And Scott, I'm glad you got to me, because it's all about the lag effects. Jim can be right, wrong today and wrong tomorrow. And, the bottom line is liquidity is still not supportive of markets right now. Money supply growth is 0%. The balance sheet is shrinking by $1 trillion in 23. The Fed funds rate is climbing, and the Fed is still engaged. And a pause does not get us back to the kind of liquidity support that's going to be required to have multiples as high as they are. So the upside is definitely capped. That means, as Mike points out, it's all about earnings, and the upside in 23 is going to be driven by earnings. Remember, in an inflationary environment, earnings can elevate because inflation is beneficial to the top line because it allows companies to pass through some of those costs to consumers. So then are you going to be able to maintain the same level of margins in a different environment where the Fed is still tightening And, earnings are likely to decelerate, which pushes multiples up. So I don't think a pause is enough. I don't think earnings being flat is going to be enough. And therefore, you have to ask yourself, is this a risk worth taking? And the answer for us is, as we've approached the 200-day moving average every time, and today again, at 39.75, we bounced off of it.